All right, let's dive into the world of money and strategies for building wealth, guided by two giants in the field.
Mhm.
We've got Tony Robbins's Money, Master the Game, and Peter Lynch's classic One Up on Wall Street. So it's like having a self-help guru and a Wall Street legend, both offering their own blueprints for, building out financial freedom.
And it's really interesting to see how both of them, despite coming from such different backgrounds, really emphasize understanding the rules of this game we call money, something that Tony Robbins jumps right into.
Yeah, I noticed that right away. He's like, hey, wake up. This is a game, and you need to know the rules if you want to win.
Exactly. And he makes a strong case that the financial industry often, benefits from making things seem overly complicated.
Right. Like, keep it confusing so we don't ask too many questions.
Yeah, yeah, almost like they're speaking a different language, and Robbins wants to translate all that for the everyday investor. One of the things he drops that really hit me was that most financial advisors aren't legally required to put your interests first.
Wait, really? I thought that was, like, their whole job.
Right, you would think so, wouldn't you? But that's not always the case. It's a real wake-up call that you're ultimately responsible for your own financial well-being.
It's a bit unsettling when you think about it.
It is. It makes you realize you really need to be in the driver's seat, educated and informed, making those decisions for yourself.
Exactly. You can't just blindly trust someone else to handle your money. But, okay, so Robbins lays out these problems, this kind of rigged game, but then he goes on to offer solutions.
Oh, absolutely. He's not just about pointing fingers. He gets really practical and tactical. For instance, he completely dismantles this myth that chasing returns is a winning strategy. He argues that consistently beating the market is virtually impossible for the average person.
So what's the alternative? If we can't just pick hot stocks and time the market perfectly, what are we supposed to do?
Well, that's where Peter Lynch's One Up on Wall Street comes in. He kind of flips the script and suggests that everyday investors, like you and me, might actually have an advantage.
Wait, hold on. Are we really supposed to believe that we can compete with those Wall Street giants with all their algorithms and fancy tools?
Lynch would say, absolutely. He points to his own incredible success with Pebble Beach Golf Course as a perfect example.
Okay, now I'm intrigued. I need to hear this story.
So the company's stock price was super low at the time, but Lynch saw potential that everyone else was missing. He realized that its assets, including that iconic golf course and all the land around it, were worth way more than the stock market was reflecting.
So he saw the value that was hidden in plain sight.
Exactly. And just 3 years later, Pebble Beach got acquired for more than triple its stock price. The crazy part, the gravel pit on that property alone was worth more than the entire company's market value when Lynch recommended it.
A gravel pit. Who knew?
Right. That's Lynch's whole point. He wants us to look beyond the obvious, to think about those hidden assets and the value they hold. You don't need to be a financial whiz to spot these opportunities. Your everyday experience, your knowledge of your local area, your understanding of different businesses, that's your edge.
So it's about connecting the dots between our daily lives and the world of investing?
Precisely. And this brings us to one of the most important principles of building wealth, the magic of compounding.
All right, tell me more. I'm all ears.
So Robbins uses this incredible story about two brothers to illustrate the concept. Imagine two brothers. Both decide to invest. The first brother, let's call him Early Bird, starts putting away $2,000 every year at age 19, but then he stops at 26. The second brother, we'll call him Late Bloomer, starts investing the same amount, $2,000 a year, but he starts later at age 27.
Okay, so early bird invests for 7 years and late bloomer invests for much longer.
Right. Late Bloomer keeps going all the way to age 65, so naturally you'd think he'd end up with more, right?
Yeah, that makes sense. The more time you invest, the more money you make.
Well, here's the mind-blowing part. The brother who invested less money and for a shorter time, Early Bird, actually ends up with 600% more at age 65.
Wait, what? How is that even possible?
It's the power of compounding. Starting early, even with small amounts, allows your money to grow exponentially over time. It's like a snowball rolling down a hill, gathering more snow, more momentum as it goes.
So even small contributions can make a huge difference in the long run if you start early enough.
Absolutely. And Robbins offers some great tips for making the most of this. He suggests increasing your savings rate every time you get a raise. You probably won't even notice the difference in your spending, but your future self will definitely thank you.
That's smart. It's like tricking yourself into saving more.
Right. Out of sight, out of mind. He also recommends taking advantage of those automatic savings plans like a 401k. They just take the money out before you even see it.
Okay, I like the sound of that. Making it automatic takes the willpower out of it.
Robbins even goes a step further and includes an email template in his app that you can send to your boss or HR to get that automatic savings plan set up.
Wow, he's really holding your hand through the process.
He's all about taking action,
Mhm.
not just talking about it, but actually doing it.
All right, I'm sold. So we've got these basic principles. Understand the rules, harness the power of compounding, and start looking for those hidden opportunities. What else do we need to know to really master this game?
Well, let's dive into some specific strategies for evaluating companies and making smart investment choices.
Sounds good to me. Let's do it. Okay, so we've talked about spotting those hidden opportunities, the gems that Wall Street might be overlooking. But how do we know a good investment when we see one? What should we actually be looking for?
Well, Peter Lynch has some great insights on this. He actually warns against something he calls diversification.
Diversification. Did you just make that up?
Nope, it's a real term he uses. And it's basically when companies try to do too much, they spread themselves too thin by branching out into businesses that have nothing to do with their core strengths.
Ah, so like a restaurant chain suddenly deciding to get into the closing business?
Exactly. A perfect example. Lynch actually uses his own experience investing in Bildner's, a gourmet grocery store, to illustrate this point.
Okay, what happened there?
Well, initially it was a successful niche business, catering to a specific market, but then they tried to expand too quickly into new areas and product lines, and their resources got stretched too thin. They just couldn't manage it all effectively.
So it's like they lost focus on what made them successful in the first place.
Precisely. And eventually they ended up filing for bankruptcy. It's a classic case of overreaching.
So how do we avoid falling into this diversification trap?
Lynch's advice is to be patient and do your research. Don't just jump on the bandwagon because something sounds exciting. Wait and see if a company's expansion plans are actually working before you invest your hard-earned money.
So it's about being cautious and observant, not just following the hype.
He actually tells a story about a company that really wanted to get attention from Wall Street analysts, but for some reason, nobody was biting.
Why would a company want to stay under the radar like that?
Well, it wasn't intentional.
Hmm?
They really tried to drum up interest, but the analysts just weren't interested.
So what happened?
The funny thing is the company actually continued to perform really well. They were quietly growing and succeeding, even without all the Wall Street fanfare.
Sounds like they were flying under the radar and doing just fine.
And by the time Wall Street finally caught on, their stock had already become a five-bagger, meaning it had increased in value 5 times over.
Wow. Talk about a missed opportunity for those who weren't paying attention. It really highlights the importance of doing your own homework and thinking for yourself.
Exactly.
Yeah.
Lynch believes that everyday investors have the potential to uncover these hidden gems if they're willing to dig a little deeper and not just follow the crowd.
Okay, now I want to shift gears a bit and talk about something Tony Robbins calls all-weather returns. He learned this strategy from Ray Dalio, a billionaire hedge fund manager. And fun fact, Dalio actually started his career in a rather unexpected way by helping to create the Chicken McNugget for McDonald's.
It's true. You never know where brilliant minds will pop up.
Okay, so back to this all-weather strategy. What's the basic idea?
It's all about building a portfolio that can weather any storm, regardless of what the market throws at you.
So it's about stability and resilience.
Exactly. And Dalio believes the key to this is diversification. He advocates for spreading your investments across different asset classes, things like stocks, bonds, gold, and commodities.
So that old saying, don't put all your eggs in one basket.
Precisely.
Mm.
But of course, the question is, how do you know what the right mix is for you?
Right, because every investor is different with unique circumstances and goals.
Well, Robbins actually shares the specific asset allocation that Dalio uses for his own portfolio.
Okay, I'm all ears.
So Dalio recommends 30% stocks, 40% long-term bonds, 15% intermediate-term bonds, 7.5% gold, and 7.5% commodities.
Wow, that's incredibly specific. Is he suggesting that everyone should follow this exact formula?
Well, it's a great starting point, and it illustrates the principle of diversification. But it's important to remember that this is a simplified version. Dalio's actual hedge fund utilizes more sophisticated strategies and investments.
Right, it's tailored to his specific needs and risk tolerance.
Exactly. The key takeaway, though, is the importance of spreading your risk across different asset classes to create a portfolio that can potentially weather any storm.
It makes you wonder if your own portfolio is balanced appropriately. It might be time for a checkup.
It's always a good idea to revisit your investment strategy periodically and make sure it's still aligned with your goals and risk tolerance.
Okay, now let's talk about Robbins' interviews with some of the most successful investors in the world. He had this really fascinating conversation with Paul Tudor Jones, a legendary hedge fund manager who's known for his ability to predict market moves. What insights did Jones share?
Well, Jones revealed what he considers to be his two main secrets to success: protect the downside and risk a little to make a lot.
So it's a balancing act between caution and calculated risk.
Exactly. He believes that preserving capital is absolutely crucial, because if you avoid those big losses, you can stay in the game longer and take advantage of opportunities when they arise. He's all about finding those investments where the potential reward significantly outweighs the potential risk.
That makes a lot of sense. But how do you actually identify those opportunities? It seems like it would involve a lot of guesswork.
Well, Jones actually advises against trying to predict the unknowns, things like the future of the market or the economy. He says nobody can really do that consistently.
So then what does he focus on?
He focuses on the knowns, the current trends and market dynamics that are already in play.
So it's about recognizing patterns and acting decisively.
Exactly. It's about being observant, recognizing opportunities as they emerge, and taking calculated risks.
He makes it sound almost like surfing, riding the waves of the market.
I love that analogy. Now, Robbins also had another really interesting conversation with Ray Dalio this time about what Dalio considers to be the most important asset class of all.
More important than stocks, bonds, or real estate? I'm on the edge of my seat.
Dalio believes that the most valuable asset you possess is your mind. Having the right mindset, the right mental framework for approaching challenges and making decisions is crucial for success in any area of life, but especially in investing.
So it's not just about the numbers. It's about having the mental and emotional fortitude to navigate the complexities of the financial world.
Absolutely. Dalio emphasizes the importance of being a lifelong learner, constantly seeking out new knowledge and new perspectives. He also believes in having a strong internal compass, a set of principles and values that guide your decisions.
It's like having a personal code of conduct for navigating the financial world.
Exactly. It helps you stay grounded and focused on your long-term goals, even when things get turbulent.
Okay, so we've explored a lot of high-level concepts. I want to shift gears now and get into some more practical advice. What does Peter Lynch have to say about the actual mechanics of buying and selling stocks? He's considered a master stock picker, so his insights here must be incredibly valuable.
Lynch is all about doing your homework. He really stresses the importance of thoroughly researching companies before you invest, and then staying informed about those companies once you own them.
So no more blindly following those hot stock tips.
Definitely not. Lynch encourages you to think independently and to trust your own judgment. He believes that some of the best investment ideas come from your own personal experiences and observations.
So it's about paying attention to the world around us and connecting the dots.
Exactly. Think about the products and services you use, the companies you admire, the trends you're noticing in your community. That's where your local edge comes in.
That's a really empowering concept. It makes investing feel much more accessible.
Now, when it comes to selling stocks, Lynch doesn't believe in hard and fast rules. He says there are many factors to consider, including the company's performance changes in the industry and the overall market environment.
So it's not as simple as buy low, sell high.
It's rarely that simple. Lynch actually cautions against selling a stock just because it's gone up in price. If the company's story is still strong and you believe in its long-term potential, there might not be a reason to sell just because you've made a profit.
I've definitely been guilty of that in the past. Sometimes it's hard to resist that urge to cash in.
Lynch tells a story about selling his Disney stock way too early because it had doubled in price. He thought he was being smart, but little did he know Disney stock went on to increase in value by more than tenfold after he sold.
Ouch, that's a lesson I won't forget. It really highlights the importance of taking a long-term perspective and trusting your instincts.
He also warns against selling a stock just because it's gone down in price. If the company's fundamentals are still solid, a temporary dip might be a buying opportunity, not a reason to panic and sell.
So it's all about keeping a cool head and not letting your emotions dictate your investment decisions.
Exactly. Lynch stresses the importance of staying objective, focusing on the facts, and not getting caught up in the emotional roller coaster of the market.
Easier said than done sometimes.
For sure. But it's a skill worth developing. And he offers another important piece of advice. Don't fall in love with a stock.
But what if it's a company you really believe in?
It's great to be passionate about the companies you invest in. But remember, your primary goal is to make money. If a company's story starts to unravel or its fundamentals deteriorate, don't be afraid to cut your losses and move on, even if it's a stock you've held for a long time.
So it's about being adaptable and responsive to changing circumstances.
Exactly. You've got to be willing to adjust your strategy as needed. Now, we've talked a lot about the financial aspects of wealth building, but there's another really important dimension that I want to touch on, something that both Robbins and Lynch emphasize the power of giving back.
That's something I've been thinking about a lot lately. As we build our wealth, how do we make sure it has a positive impact on the world?
Well, Robbins dedicates a whole section of his book to this concept. He argues that true wealth isn't just about accumulating money. It's about making a difference in the lives of others.
It's about using your resources for good, but sometimes it's hard to know where to start.
Robbins shares a very personal story about a time when he was actually struggling financially. He was down to his last few dollars and feeling pretty discouraged when he encountered a homeless man asking for money. Even though Robbins himself was barely getting by, he gave the man his last $5.
Wow, that's really powerful. It takes a lot of courage and compassion to give when you're struggling yourself.
It was a turning point for him. He realized that even in the midst of his own hardship, he still had something to give.
Yeah.
And that act of generosity actually brought him a sense of peace and purpose that he hadn't felt before.
It's amazing how giving can shift our perspective and bring us a sense of fulfillment, even when we might not feel like we have much to give.
Exactly. And Robbins points out that there's actually scientific research to back this up. Studies have shown that giving can increase your happiness and well-being. It actually triggers the release of endorphins in your brain, leading to what some call a helper's high.
So giving isn't just good for the soul, it's good for our health, too.
Exactly. And Robbins encourages us to make giving a part of our financial plan, to actually allocate a portion of our resources to causes that we believe in. He suggests starting small. Even donating a small percentage of your income or volunteering your time can make a difference.
That makes it seem a lot less daunting. You don't have to be a millionaire to make a positive impact.
And as your financial situation improves, you can gradually increase your giving. Robbins believes this actually creates a beautiful cycle of abundance.
So it's like a positive feedback loop. The more you give, the more you have to give.
Exactly. It's a beautiful way to connect our financial success with a sense of purpose and meaning.
I love that idea. So we've covered a lot of ground in this conversation. We've talked about everything from practical investment strategies to mindset shifts and the importance of giving back. It's been incredibly insightful.
It's been a pleasure exploring these concepts with you. I hope you're feeling inspired and empowered to take control of your financial future.
I definitely am. I feel like I've been given a masterclass in personal finance.
That's great to hear. Remember, the journey to financial freedom is ongoing. There will be challenges along the way, but with the right knowledge, strategies, and mindset, you can achieve your goals.
Okay, so we've covered a lot of ground in parts 1 and 2. Now it's time to move on to the final part of our deep dive, where we'll explore even more practical tips and strategies for mastering the game of money. Stay tuned. All right, we're back for the final part of our deep dive, and I'm ready to put all this wisdom into action, start making some real moves.
It's been quite a journey, hasn't it?
Yeah.
Decoding those rules of the game, exploring those hidden opportunities, and even peeking into the future of finance.
And I feel like we've just scratched the surface.
Absolutely. There's always more to learn, always evolving. But I think we've given you a pretty solid foundation.
Speaking of foundations, let's circle back to Tony Robbins' book for a minute. I was really struck by his section on what he calls the 9 myths that hold people back from achieving financial freedom.
Yeah, those myths are like roadblocks on the path to financial success, often perpetuated by, the financial industry itself.
So, they benefit from keeping us in the dark.
In a way, yes. So it's crucial to shine a light on these myths and empower people to make informed decisions.
Okay, I'm ready to bust some myths. What's the first one we need to tackle?
Well, one of the most pervasive myths out there is the idea that mutual funds are the best way for the average person to invest.
Really? I always hear that. Isn't that what most financial advisors recommend?
It's a common belief, but Robbins really challenges this head on. He argues that while mutual funds offer convenience, they often come with these really high fees.
So you're paying for that convenience, but it could be eating into your returns in the long run.
Exactly. He actually cites a Forbes article that found the average mutual fund has fees of around 3.17%.
Whoa, 3.17%. That's a big chunk of change going straight to the fund managers, not your own pocket.
Right. And Robbins really takes aim at what he calls fee factories, those institutions that charge excessive fees for their services.
Okay, so how do we avoid getting trapped by these fees? How do we keep more of our money working for us?
Well, Robbins suggests a few things. First, he challenges readers to really look at their total annual fees and try to get those investment costs down to 1.25% or less on average.
That sounds like a pretty ambitious goal.
It is, but it's achievable. Robbins recommends working with a registered investment advisor, someone who can help you allocate your assets strategically and rebalance your portfolio when needed.
So get a professional on your side to help you navigate those choppy waters.
Exactly. He also suggests investing in low-cost index funds, like the ones offered by Vanguard.
Vanguard, isn't that the company founded by Jack Bogle, like the pioneer of index funds?
Yes. And Robbins actually includes an interview with Bogle in his book, where they discuss the power and simplicity of index fund investing.
I'm sensing a theme here. Keep it simple, keep those costs low.
That's a great takeaway. And it leads us nicely to another myth that Robbins dismantles: the belief that you need a ton of money to start investing.
Right, that's a big one that holds a lot of people back. They think, oh, I'm not rich enough to invest. I'll worry about it later.
Exactly. But Robbins says that even small amounts, consistently invested over time, can grow into something substantial.
So it's not about winning the lottery or inheriting a fortune. It's about building those good habits, starting early and staying disciplined.
Precisely. He emphasizes making investing a regular part of your life, no matter your income level. And to help you figure out exactly how much you need to invest, Robbins provides a tool in his book called the Wealth Calculator.
A wealth calculator. That sounds pretty cool. What does it do?
It basically helps you calculate how much money you'll need to reach your financial goals based on your current income, savings rate, and investment returns.
So it takes the guesswork out of financial planning.
Exactly. It gives you a clear roadmap.
Okay, that sounds incredibly helpful. Where can we find this wealth calculator?
Well, Robbins makes it available for free through his app.
All right, one more thing I want to touch on. Asset allocation. This is all about deciding where to put your money and in what proportions, right?
That's right. Asset allocation is crucial. It can make a big difference in your overall investment returns and how much risk you're taking on.
It's like choosing the right mix of ingredients for your financial recipe.
Exactly. Robbins argues that it's even more important than picking individual stocks or trying to perfectly time the market.
So it's about building that diversified portfolio, spreading your investments across different asset classes.
Precisely. And Robbins actually outlines three main buckets for asset allocation: the security bucket, the risk growth bucket, and the dream bucket.
Okay, let's break those down. What's the security bucket all about?
Think of this as your financial safety net. It's where you put the money that you absolutely can't afford to lose.
So low-risk investments that are easily accessible if you need them.
Exactly. Things like cash, cash equivalents, and short-term bonds.
Okay, what about the risk growth bucket?
This is where you allocate funds for potential growth, even if it means taking on a little more risk.
So this is where things like stocks, real estate, or even more volatile investments might come in.
Yes, but it's important to diversify within this bucket too. Don't put all your eggs in one basket. Remember Lynch's warnings about deal worsification.
Right. Spread that risk across different industries, different companies.
And last but not least, we have the dream bucket.
Mm.
This is where you set aside money for those big long-term goals.
The fun stuff. Travel, that dream house, early retirement.
Exactly.
Mm.
Robbins encourages us to dream big and consistently contribute to this bucket, even if it's just a small amount at first.
It's like planting those seeds for your future.
Exactly. It's about making progress toward those dreams, no matter how far off they may seem.
I love that. It's not just about financial security. It's about aligning your investments with your passions and your aspirations.
Absolutely. It's about designing a financial life that truly reflects your values and your vision for the future.
This has been such an incredible deep dive. I feel like we've been given a masterclass in personal finance. I'm energized and ready to start putting all of this into action.
That's what it's all about. Remember, the journey to financial freedom is an ongoing process. There will be ups and downs, but with the right knowledge, the right strategies, and the right mindset, you can achieve anything you set your mind to.
Thank you so much for joining us on this incredible journey into the world of money. We hope you've gained valuable insights and practical tools to help you master the game of money and create the financial future you deserve. Until next time, keep learning, keep growing, and keep striving for financial freedom.
And never forget, the most valuable asset you possess is your mind. Invest in it wisely, and it will pay dividends for a lifetime.